Today, we're diving into Redfin's 2026 housing market predictions. We'll cover everything from mortgage rates to affordability to which markets could see a cool down or a heat up. I'm Kathy Fedke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fedke, the real estate investor's resource.
Today, we're joined by Redfin's chief economist, Daryl Fairweather. Daryl and her team just released Redfin's 2026 predictions. Welcome to the Great Housing Market Reset. There's a lot in this year's outlook that could reshape how buyers, sellers, and investors navigate the market. But before we bring Daryl on, I want to let you know about our live event coming in January. It is the Passive Wealth Expo. We'll be bringing out 11 property teams from around the country in some of the best markets where you could still get cash flow and a chance of appreciation in the future over time because of the job growth in those areas. I'll also be giving my housing market predictions, and Rich Fedke, my hubby, will be doing his very famous workshop on the focused investor. You don't want to miss that if you haven't done it already. And if you have, you know what you have to look forward to. You could get all the details at realwealth.com/expo. It's on January 24th from 8:30 in the morning till 6 p.m. in South San Francisco. So again, you can get those details at realwealth.com/expo. So let's get on with the show. Daryl, welcome to the Real Wealth Show.
Thank you for having me. I'm excited to be here.
I'm excited too, because we're going to talk about Redfin's 2026 predictions. One of my favorite things to do. But first, let's just start with who you are and what you do at Redfin.
I'm the chief economist at Redfin. I study the housing market and its relationship to the economy. We cover everything from housing affordability to how home buyers and home sellers are making their decisions of whether to sell and buy, and how everything that's going on in the economy is impacting the housing market.
And this is that time of year when everybody wants to know what economists think about 2026. And it's so hard. It's so hard to predict. I mean, how close were you last year on the predictions?
I was looking back at our predictions last year, and we're actually pretty close. We predicted, this very modest increase in home sales. I think we were a little bit more optimistic about price. We got it pretty close. I was pretty happy with how we did.
Oh, that's wonderful. Okay, so moving on to 2026, do you think it's easier to predict? Are we going into a more normalized market, or are we going to see these crazy ups and downs again?
I think that the market will feel slightly better than it did this year. We're entering into a new phase of the housing market where affordability will improve, but that improvement will come very slowly as income growth starts to outpace the price of homes. And with rates being flat, maybe more likely to come down towards the end of next year, that will also offer an affordability boost.
I was just going to ask that as my next question. Obviously, real estate is so rate sensitive. I used to not realize quite how sensitive it is, but it certainly has been. And just over the last couple of months, we have seen rates come down closer to 6%. And as a result, more pending sales. So definitely sensitive. But I think I just heard you say you think they might go down further. Why would that be?
Well, I think for most of the year, rates will stay where they're at, and that's because of the state of the economy. We have high inflation. It's at about 3%, which is above the Fed's target. We also have a weak labor market. The inflation part, it should start to resolve itself, but it's probably going to be a really slow process. That's why I think we get rate relief. It probably won't happen until the end of next year. So for most of the year, we're going to be pretty much where we're at in terms of mortgage rates.
Okay, so maybe just towards the end of next year. And that makes sense because if the job market's softening, people aren't going to be spending as much potentially, although we just came off of Black Friday and I know I spent some money. I think a lot of other people did too. And now we're going into the holidays. But that's interesting. I've seen and heard so many mixed reviews, but not too many people saying that they think that mortgage rates are going to go up substantially.
I mean, there is a risk that rates go up. We saw a lot of volatility at the beginning of 2025 with the tariffs being announced, and then there's a lot of confusion about how they would be rolled out. And also there was some discussion from the president about replacing the Fed chair, which also led to more volatility. And all of that pushed up mortgage rates at the beginning of 2025. So there's a risk that we could have something similar happen in 2026 where There's just a lot of uncertainty politically in the economy, and uncertainty tends to push up mortgage rates.
Let's go back to affordability because that's really been the story of the year, and slightly lower mortgage rates is helping with that, but also more inventory on the market and prices stabilizing, and in some areas even softening. So what would improve affordability moving into 2026?
So we are expecting home prices to only increase 1% next year, which is slower than how much wages have been improving. So
Mm.
assuming we stay on this path where, the labor market's a bit weak, but it's not terribly weak, wages should continue to improve at a pace that's faster than what we're seeing in terms of home prices. And then just rates are lower than what they were last year. That's already true. So that will add, a benefit in terms of affordability for home buyers.
Yeah, that's what I've been saying when we talk about affordability. I could be totally wrong on this, but I feel like it's a shorter term problem than a longer one. And, we shall see. But what happened in 2020 and 2021 and a little bit in 2022 was that rates were so low, so incredibly low that created home price appreciation that jumped us years ahead of where that price appreciation would have been had rates just been normal. But at some point, we are going to get to that level where home prices would have been at a more normal 3 or 4% appreciation versus in some markets 20%. So I don't know if you've run that kind of analysis of where would we be had we not had those massive increases in appreciation. At what point would we be at this price level? Have you looked at anything like that?
We have looked at how affordability is going to improve over the next decade, and it should start to improve from where we are right now. But the thing is that, I've been Redfin's chief economist since 2018. And when I first started in 2018, we were already talking about how unaffordable housing was. So
Mm.
if it takes a decade for us to get back to 2018 housing affordability levels, I don't think we can call that necessarily a success story. I think there are still going to be quite a lot of people who feel like the housing market is inaccessible to them because of how expensive it is.
So is there a solution? I know there's a lot of talk about different things like portable mortgages, like 50-year mortgages, like can we get to manufactured housing? What's it going to take to get back to affordability? And I didn't realize that in 2018 that it was already an issue, but that makes sense.
We really need to make it easier to build more housing in the places that people actually want to live. It's not a
Yeah.
solution to just build homes, out in the exurbs on the outskirts of cities and say like, look, we're building more homes. That solves the affordability problem because those single family homes are going to be at an expensive price point. And if you are trying to get to a job in the city, you're going to need a car, maybe two cars if you're a family. You're going to be spending more on gas. You're going to be spending your time commuting, and it doesn't really like make people's lives better off the way that allowing for more dense housing near jobs, near the places that people actually want to live would help people, achieve affordability. So we've seen some movement there over the last year, particularly in California. They've legalized dense housing near transit, which is a great step in the right direction. And hopefully we will see more measures like that really across the country in all of the cities that are the strongest labor markets.
And in some of those areas, it's already dense. You look at New York City, how do you bring on more supply there? How do you bring on more supply in San Francisco or LA where it's just already built and you have limitations, right? You've got oceans blocking you. You can't build there. It seems like all you can do is.
There is opportunity to even densify a city like New York. I think most people think about downtown Manhattan when they think about how dense New York is, but in Uptown there are single family homes that could contain more units. If you go out into the boroughs, then there are single family neighborhoods that could be upzoned, that could be rezoned to allow for triplexes, additional dwelling units, things like that. There are parking lots even in the boroughs that could be changed into housing. So I feel like we always have to be thinking of new ways to increase the availability of housing and densifying housing and making sure that we're making the best use of the land that is available.
A really good point. Okay, so do you think that the Fed will cut rates in December? Let's start there.
I mean, the market is pricing in a Fed rate cut. I'm a little bit more skeptical of a cut than what the markets are showing. Like, I think it's really going to be a nail biter. I think there are going to be plenty of members who are going to be advocating to hold rates where they're at because of how high inflation is. And I also think this AI bubble everyone's been talking about
Hmm.
is a concern because if you cut rates, that makes it even cheaper to fuel that bubble. Most bubbles are driven by debt, but debt has been quite expensive. That's probably keeping that bubble in check. But if you start cutting rates, then things could get a bit out of control. But I think inflation is really the more important point that it's just been, multiple years at above 2% inflation, and that hurts the Fed's credibility. It's really important that they get that down and show that they are committed to it. If they cut simply because there's some labor market weakness, then, I think that it risks inflation starting up again and becoming an even more persistent problem.
So this AI bubble, we've talked about it a bit on this show. Would the bursting of that bubble affect just certain real estate markets or just the whole country?
If the AI bubble were to burst, and I don't think it's going to burst next year, I think if it's going to happen, it needs a couple more years before that
Yeah,
happens.
to really
Just
inflate.
to
Right.
really like be a problem
Yeah.
for the overall economy. But if it were to burst, we would see rates fall because the Fed would need to worry about liquidity in markets. They would need to make sure that in a crisis like that, the markets are still moving, and that would require them to lower rates to do that. We saw something kind of similar happen during the Silicon Valley bank collapse a
Mhm.
few years ago, but it was short-lived, the decline in rates. So it really does depend on how big of a crisis it is and how widespread it is. Forecast what the impact on rates would be, but directionally, it would move rates down.
Well, maybe the fact that everybody's talking about it will have investors wake up and
Exactly.
just not create it.
Exactly.
Yeah. Okay. So, what markets might cool down in 2026?
In 2026, the markets that will continue to cool down are in the Sun Belt. That's where there's been a lot of new construction, and it's more of a buyer's market than it is a seller's market. Um, the parts of the Sun Belt that are experiencing increases in insurance costs are going to cool down even more because that's just an added expense for home buyers, that increasing insurance. Same goes for utilities. Like if energy prices increase the way that a lot of economists are forecasting, people aren't going to want larger homes because they're more expensive to heat and cool. So yeah, I think the Sun Belt is vulnerable. Larger homes and risky and homes that are in more climate risky areas will be less popular.
So, when you say the Sun Belt, you're really talking about the cities within the Sun Belt that got overbuilt.
Yeah, it's been mostly in Texas and Florida. Florida has really been down this year, and I think that will continue into next year.
Okay. And then Austin, for example, that's already been hit so hard. You think it has further to go?
Austin is interesting because I think it still has appeal because of its labor market. That's true for
Hmm.
a lot of these Texas cities. I see Texas as being not quite as vulnerable as Florida, although Houston, because of its increasing insurance costs, I think that could be more vulnerable. But, I think across the board, things are going to improve slightly. So whether or not Austin continues to deteriorate, I think it could go either way.
Okay. And then on the flip side of that, what markets do you think would have the most upside in the coming year?
Areas in the Great Lakes region and also upstate New York, I think will attract more demand. These places are like some of the most affordable markets in the country. You can still find homes for like 200, $300,000 there. So the effect of high mortgage rates is not as severe when the price point is so low. And then because New York City is expensive, Philadelphia, these other kind of East Coast metros have become expensive. People are going to start looking at the next most affordable places, like in Rochester, New York, or Cincinnati, Cleveland. They're going to move a little bit further west into the Midwest, and it also has the appeal that it doesn't have the same insurance cost problems as some of those southern metros.
Yep, those are some places that have been on our list of hot markets for a while. I mean, Cleveland just keeps pumping along.
Mhm.
What about home sales? So many YouTube quote unquote experts were predicting a housing crash, and we had a crash, but it wasn't the kind that they were talking about. They were talking about a price crash, and what we seem to really have is a sales crash. Sales went way down when affordability went up. So how it seems like it's improved a teeny weeny bit in the last few months. Where do you see things going in 2026 in terms of sales?
Sales we forecast are going to improve 3%. And that's, maybe not the improvement that a lot of housing professionals or home buyers or home sellers would like to see, but it is an improvement. And that's really facilitated by the lower rates that we're going to see this year compared to last year.
And how about for current homeowners? I mean, for the most part, I have been saying that current homeowners are probably in the best position they've been in, at least the ones that bought, before 2022, before rates went up. They are sitting in low payments, low rates. Do you think that will loosen up at all with refis as we get closer to the 6%, or are they going to just keep holding on?
We expect a refi boom next year, an increase of
Oh, wow.
30% in activity because of the fact that rates are lower than they were last year. And also there are more people who got into higher rates, like near 7% rates. They're going to be doing the math on whether to refinance now that rates are lower, and they're going to realize that they could save money by refinancing now. Also, there's a ton of equity stored up in homes. Home equity increased at a record pace during the pandemic, but it has not been tapped because of that whiplash in rates. And I think there are going to be a lot of people who are going to want to tap that equity because they have credit card bills or they have other sources of debt that they would like to pay down. And at the rates that we're seeing for mortgages right now, it probably makes a lot of sense for them to do that.
And then renters. So many of our listeners are homeowners, but they also own rental properties. Where are you seeing rents? I get mixed reviews on if they're going up or if they're going down. It probably depends per market. And is it different between single family and multifamily? So where are rents now, and where do you expect them to go in 2026?
Yeah, we expect rents to rise. We're at the tail end of the boom in new construction of apartments. A lot of those units came online this last year, and now we're not going to see as many new units become available next year. And also people who chose not to buy and are renting instead, they're adding more demand to the rental market, which will likely push up rents. We are expecting the exception to be in places that typically have a high immigration population renting because immigration has slowed down so much. So places like Southern California, South Florida, there might not be so much demand for rent without that immigrant demand.
That would be sort of a breath of fresh air, I think, for some people who are struggling to pay rent. I know it's just so astronomical, but okay. Homeownership. Some of the headlines have been that the median age just keeps getting older and older, up to 40 years being the first time home buyer age. What does that mean for real estate? And certainly, focusing on 2026, it sounds like more renters, right?
Yeah, and when more people teaming up to afford their housing costs, we're predicting more multi-generational housing, more people with roommates. The housing has become so inaccessible to people in their 30s and 20s. They're going to have to figure out some creative solutions, and that might be, moving back in with your parents or encouraging your parents to build an additional dwelling unit. Now that's been legalized in so many places so that you can take advantage of that real estate that is already owned by your family and figure out how to pass that down in a way that makes sense for the entire family.
Yeah, getting creative. I mean, you've got the pad splits, renting by the room. I imagine there would be more of that as well. And I read also that single family households are increasing. Have you seen that?
Well, we are in what economists call a K-shaped economy. So for people who have a lot of their wealth in the stock market and they can get around higher interest rates by paying more in cash, and it's been a buyer's market in most of the country, there is a segment of the population that sees this housing market as being quite favorable, and it is at that upper end.
And finally, let's talk about AI. That we talked about it a little bit earlier, but you guys made a prediction. Tell me about that.
Well, we think that AI is going to be a larger part of the home buying process. People will engage with conversational chatbots on apps like Redfin to help them identify which homes meet their needs. The old way is that you go on Redfin and you type in filters, or you look at a map and go through each home one by one. But that can be inefficient compared to just telling a chatbot exactly what it is that you want. Like you want a home on a cul-de-sac that's 10 miles away from the beach or something like that. Like the AI will be able to filter to homes in a way that those click-through filters aren't able to.
Yeah, so just kind of another evolution of real estate. How do you think that'll affect agents if AI could do a lot of the work?
I think it will make agents more productive because agents spend a lot of time just setting expectations for their clients, helping them
Hmm.
understand what is actually available to them given their budget or their desires, or what the housing market is actually like for a home seller, what they can price their home at. So I think if buyers and sellers are able to have more of those tough conversations ahead of time, they'll come when they come to the agent, they'll be more educated and they'll be able to just talk about strategy for how to
Yeah.
actually get what they want, in real life once they figure out what the playing field is like.
Yeah, technology. I mean, a lot of people thought that when Redfin and Zillow came around, that agents wouldn't be needed anymore, and that is certainly not the case. There's
Mhm.
some things that AI just can't do yet. So, all right. Well, Daryl, thank you so much for being here on the Real Wealth Show. You're just a wealth of knowledge, and we really appreciate it.
Thank you for having me.
And thank you for joining me here on the Real Wealth Show. Again, you can go to realwealth.com/expo to get details on our upcoming live event, January 24th in South San Francisco, to hear my housing forecast, to hear Rich's focused investor seminar, so good, and also to meet 11 different property teams with property management in place for a turnkey real estate investment, all on that one day. Again, details at realwealth.com/expo. I look forward to seeing you there.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.